All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world. Happy Wednesday, everybody. Today is August 6th, 2025. And the top story this morning is the AI bubble. We got earnings from a couple of the AI minor leaguers last night. They weren't good. Let's start with one of my favorites. I just love this company, Supermicro Computer. Oh, those adorable little accounting frauds over at SMCI. Miss on the top and the bottom line, but it's not the big earnings miss that everybody is worried about. It's their guidance. Supermicro Computer just guided for $33 billion of revenue for this year. Now, that's interesting because back in February, when Supermicro was about to be delisted because they're a bunch of lying scumbags and frauds, their CEO, Charles Lang, came out and just randomly spit out a number. He said, oh, we're going to make $40 billion this year. It's going to be great. Never mind the whole accounting fraud thing, $40 billion, big random number. And of course, the press just reports that. The stock shoots up. They end up not being delisted. Why? Because they paid BDO, a joke of an auditor, to come out and basically rubber stamp their books. Well, now they're coming out and they're like, oh, yeah, that $40 billion. Sorry, yeah, we're not going to hit that. We were never going to hit that. That's just something we said to convince idiots to buy our stock. It's actually going to be $33 billion. Whoops. There goes all that growth for the year. What happened to the insane demand and the insatiable appetite? And, oh, the Blackwell servers, we're the only ones who have them, and we just can't build them fast enough. Everybody can't wait to get their hands on it. Nope. That never happened. It's almost like they were just lying about that, too. Isn't it funny how that works that way? Look, Supermicro is losing market share to Dell and to HP Enterprise. They're getting the server business, probably because the accounting fraud from last year and that scandal took a big chunk out of their business. Why would you do business with this company that is obviously run by liars and crooks when you could buy the same product at the same price, probably get better service buying it from HP or from Dell? And so Supermicro posted a lousy quarter. And you know what? Couldn't have happened to a nicer bunch of guys. Just couldn't. Now let's talk about AMD. Now, AMD, another AI minor leaguer, not exactly the poster child for the AI bubble. They posted an earnings miss and a revenue beat. All right. The top line looked a little bit better, a little light on the earnings. An $800 million loss thanks to export controls and a chip that AMD built specifically for China. Now, they're saying, look, the export control thing, it's probably going away because of my trade deals. And so because of that, don't worry, that $800 million loss, that'll be coming back in subsequent quarters. You know what, guys? Call me crazy, but all of this rosy, like, oh, don't worry, the trade deal with China any day now, and we're going to send them all the chips, and they're going to send them all the rare earths. Neither side is moving anything. The rare earths are not making it to the United States, and the chips are not yet making it to China. We've seen all kinds of articles in the last few weeks about how commerce is delaying the licenses to export, and the Chinese are delaying the slow rolling the rare earths. This deal may not happen, and you may have noticed the guy in charge over here in the States, he's a little bit volatile, a little finicky, prone to outbursts. Call me crazy, but I think maybe this big rare earths for AI chips thing may not happen. So AMD is kind of optimistic that that $800 million loss is going to be coming back. Look, their $872 million profit. My friend over at the Coastal Journal had a great write-up on this one yesterday. They basically manufactured all of their earnings. It's just out of thin air. $872 million profit, almost entirely made up by $834 million worth of a tax reserve release. Basically accounting gimmicks, totally manufactured all of their earnings, as well as several other things that they have done to inflate their revenue numbers. Not good results from AMD. Both of these stocks are down big ahead of the opening bell. Supermicro in particular down double digits. So look, did the AI bubble just pop? No, this isn't it. It's not going to be Supermicro or AMD that pops the AI bubble. The AI bubble was created by NVIDIA and CoreWeave and OpenAI, and they'll be the ones that fail this AI bubble. And speaking of OpenAI, they're in the press this morning as well. They're in talks to raise cash in another secondary sale at a mind-blowing $500 billion valuation. That's a $500 billion for anybody who's doing the math out there. That $500 billion valuation would be a 66% increase from the 300% valuation that they received just a few months ago in January. That number, the January $300 billion valuation, was a doubling of the valuation that they had received just a few months earlier. Just keep spouting off bigger and bigger numbers. See also Supermicro and their $40 billion in revenue. Just keep making the numbers bigger, right? And it never ends. There's never any reckoning. There's never any like reality check. Never sets in. The numbers will just keep getting bigger forever. Just keep buying your 0 DTE call options, and I'm sure everything is going to work out great for the little guy and the average investor, right? That's the prevailing wisdom right now. Here's what's not being said about OpenAI and their $500 billion attempted raise. They need it. They won't survive without it. OpenAI is bleeding two things: people and money. Other than that, the business is booming. You know, we're losing our people and we're losing a ton of money. Look, Zuckerberg is out on this spending bender. He's buying up top talent, poaching people from OpenAI, from Microsoft, from all these other companies, Scale AI. And OpenAI needs to compete with that, but they can't. OpenAI has a lot of things, but they don't have money. They lost $5 billion last year on just $3.7 billion in revenue. All right. They are running deep in the red. OpenAI doesn't just lose money. All right. They are a cash incinerating furnace at OpenAI. And if they need to pay more money to their people to prevent Zuckerberg from stealing them, well, they're going to have to raise that money somehow. Enter this secondary offering. Let them sell some of their equity-based compensation. So that's going on this morning. Again, not the popping of the AI bubble, but it's not exactly a good day for the AI bubble either. We also got a lot of earnings. Now, this is kind of interesting. We're kind of flipping the script a little bit. We had earlier this week, like all the tech earnings, or late, last week, things like that. The tech earnings were all great. Everywhere else in the economy sucked. Today, it's a little different. Today, we got the tech earnings kind of suck, and we have some pretty good results elsewhere in the economy. First of all, we had Uber, nice big beat for Uber. Their business is doing well. McDonald's, the discounts are working. They posted an earnings beat. Disney earnings beat expectations, but the revenue came in a little bit light. It seems the growth in their parks and experiences business is being overshadowed by losses in their TV segment. That's been ongoing for several years. Interesting, Disney is paying up for a couple of big deals announced with their earnings. They're buying the NFL's media assets, and they're also buying the rights to stream WWE. So we could be seeing more football on ESPN Plus, or whatever it is, the streaming service that ESPN is called these days. We could be seeing NFL games streamed on that, and we could be seeing WrestleMania being streamed on that. So Disney spending a little bit more for the content here. Open Door reported earnings, and the CEO basically said, hey, meme stock investors, thanks for buying all of our stock, but our earnings suck because the real estate market sucks. Better luck next time. Just a reminder, guys, be careful chasing these meme stock names, all right? They fall every bit as fast as they go up, all right? Some guys make money. Most people get slaughtered. And last but not least, yesterday we got the ISM Services PMI. That's pretty interesting. We saw the stag and we saw deflation in those ISM numbers yesterday. So we will look at those. They are not looking good over there. We got a lot to talk about. Once again, how about we shrink my big melon of a head and let's see what's going on in markets. And this is where I ask you to please hit that like button. And you new guys, hit that subscribe button so you can come on back tomorrow and have your coffee with the melon heads as we go through markets. And right now, despite some mixed earnings results, the market is still in positive territory. The S&P 500 is up 16 points, or 0.25%. In lieu of absolute, world-ending disaster, number will go up. That seems to be the thing. The market continues to melt up here. The S&P is up 178 points, 0.4% higher on what? Nobody knows. The NASDAQ is up 54 points, or 0.25% as well. So stocks are up across the board. We have got a slightly weaker dollar once again this morning, 98.4. That is off by 38 basis points, 36 points now. That's going to put a little bit of upward pressure on asset prices, so possibly the weaker dollar contributing to the move in stocks this morning. Looking over at the bond market, we have got yields are higher on the long end, a little bit lower on the short end. 30-year treasuries at 4.802. That's higher by 3 points and change this morning. The 10-years at 4.224. That's higher by almost 3 points. The 2 years at 3.724, higher by almost 1 point. And the 1 month is down a half a point at 4.361%. Not a lot happening in bonds this morning. Looking over at commodities, a little bit of red, a little bit of green. We've got spot gold is down $11.20 this morning, $3,369 for gold. That's off by about a third of 1%. Spot silver, meanwhile, is up a couple of cents here, 3 pennies higher at $37.84. I like the shiny. Copper, meanwhile, is up by 1% this morning. Platinum is unchanged. Palladium down 3.5%. And WTI crude is catching a bid here, up $1.25 to $66.41 for September WTI futures. That is 1.9% higher. Looking over at Bitcoin, we're down again this morning, $113,866. That's off by about $250 from yesterday. We're still in this 113 to 115 range we've been in for the last couple of days. Watch that 50-day moving average, guys. We bounced off of that 3 out of the last 4 days. Are we going to challenge that number again today? So far, that 50 line is holding. We'll see if that can continue. Now let's get into some of these earnings this morning. Supermicro, let's start with this one. Supermicro's quarterly results underwhelm and the shares tumble. Oh, that's really sad, I tell you. Supermicro missed Wall Street estimates for the fourth quarter for revenue and profit on Tuesday as the company battles larger server makers for high-performance computers used to train artificial intelligence models. Shares of the San Jose, California-based company slumped nearly 15.5% in extended trading as the results followed multiple cuts to its full-year guidance. Its forecast also fell short of its earlier lofty expectations. Supermicro projected revenue of at least $33 billion for fiscal 2026. The company had previously predicted around $40 billion in annual sales back in February. But remember, back in February, these guys were fighting for their lives. They would have said literally anything to save their own butts, anything to convince people to buy their stock, and it worked. Charles Lang and his family continue to dump shares on the open market. Imbeciles who get all of their information from Twitter continue to buy it back up. Never mind the fraud, never mind the illegal sales to China, just buy the stock. Okie dokie, how's that working for you guys? Supermicro has been gaining traction in the hyper-competitive server industry, but analysts have said larger rivals such as Dell and HP Enterprise have been able to leverage their vast customer base to boost sales. It also helps that those companies are not committing accounting fraud on an industrial scale. Since we know the market for servers is very strong right now, it is safe to assume the disappointing results for Supermicro are due to share losses, said Gil Luria, managing director at D.A. Davidson & Co. Their customers are very discerning right now and are choosing servers from Dell, HP, and others, Luria added. By the way, Gil Luria is a pretty sharp analyst. I've had him on the channel before, and I'm learning to trust his analysis. He's pretty good. What he's saying here is this is not reflective of an overall slowdown in spending in AI. This is just Supermicro losing market share to their competitors. So I don't think you want to draw any conclusions about what NVIDIA's earnings are going to look like based on this information alone here. All indications from big tech spending and their CapEx numbers suggest NVIDIA is going to post another blowout quarter. I just don't think this is the bubble or the pin that pops the bubble. But for now, Supermicro shares down 17%, $47.51, off by $9. But look, this stock was already up 80% this year. They were trading down in the 20s not too long ago when they were at risk of being delisted. They came in, they hired BDO to rubber stamp their books, and the delisting risk went away, and everybody just piled into the stock. But long-term, fraud doesn't pay. Sooner or later, reality is going to set in for this company. And again, it couldn't have happened to a nicer bunch of guys. Meanwhile, AMD reports weaker than expected earnings, even as revenue tops estimates. Yeah, about those revenue numbers, though. Let's see what's going on. AMD reported quarterly earnings on Tuesday that missed estimates. The stock slid about 5% in extended trading. Here's how the chipmaker did versus expectations. Earnings per share were 48 cents adjusted versus 49 cents expected, and revenue $7.69 billion versus $7.42 billion expected. So a miss on earnings, a little bit of a beat there on revenue. For the current quarter, AMD expects sales of $8.7 billion, plus or minus $300 million versus expectations of $8.3. So the guidance wasn't terrible for AMD. Now, during the quarter, AMD announced new AI chips called the Instinct MI400 that are expected to hit the market next year. OpenAI CEO Sam Altman committed to using AMD's newest GPUs. AMD is also grappling with chip export controls that have been placed on some of its AI chips because the U.S. government worries that powerful GPUs could be used by adversaries to surpass American capabilities or be used for military purposes. By the way, got a video coming out later today. That thing that isn't happening just happened again. Chinese buying GPUs illegally. Oh, that thing. Yeah, that happened again. Whoops. Look for that later today. AI business revenue declined year over year as U.S. export restrictions effectively eliminated the MI308 sales to China, and we began transitioning to our next generation. AMD CEO Lisa Su said on a call with analysts, the MI308 was previously barred for export to China in April, which the company said cost it $800 million in the June quarter. However, the company said in July that it expected shipments to resume after the Trump administration signaled that it would approve waivers. AMD said its outlook doesn't include any revenue from its China-focused AI chip called the MI308, and its license applications are currently being reviewed by the Department of Commerce. We had an article earlier this week that said the Department of Commerce was taking their sweet time on those reviews. Sue said she expects AI revenue to grow year over year in the current quarter. Now, I want to send a shout out to my friend Samantha LeDuc on X and also my friend Greg over at the Coastal Journal. Check this one out. She's quoting Greg's latest Substack post. AMD reported $872 million in net income, but that number was almost entirely artificial, padded by an $834 million one-time tax reserve release and a $104 million gain from discontinued operations. Strip those out, and the company would have posted a pre-tax loss. Management also touted strong cash flow, but a deeper look reveals that cash came from selling off future revenues, literally factoring receivables to pull money into the current quarter. Oh, that sounds a lot like channel stuffing. That trick alone added $330 million. They also delayed $836 million in payments to vendors, inflating the optics of free cash flow. Artificially boosting cash flow by factoring receivables and delaying vendor payments distorts the true health of the business and creates the illusion of strength while masking underlying weakness. Shout out to the Coastal Journal and Samantha LeDuc for that one. In other words, AMD's earnings, they were even worse than the market realizes. And right now, AMD stock is down almost 6%, $163.94. That's off by $10. So, look, the two minor leaguers not doing so well here. But again, guys, I just don't think this is the bubble popping here. Case in point, the valuations are still moving higher. We got this one in Bloomberg. OpenAI is in talks for a share sale at a $500 billion valuation. And as long as they can still raise cash at higher and higher valuations, then they can continue to afford spending that cash on rentals or purchases of NVIDIA's chips, and NVIDIA's earnings are going to keep going up. So as long as this investment cash keeps flowing, this bubble isn't going to pop. OpenAI is in early talks about a potential sale of stock for current and former employees at a valuation of about $500 billion, people briefed on the investment discussion said, marking an enormous gain in value for the AI leader. The company is targeting a secondary stock sale in the billions of dollars, the people said, asking to remain anonymous because they weren't authorized to discuss the matter publicly. Existing investors, including Thrive Capital, have approached OpenAI about buying some of those employee shares, the people said. If the deal goes ahead, it would elevate OpenAI's on-paper price tag by roughly 2/3. Its previous valuation stood at $300 billion in a $40 billion financing round led by SoftBank, making it one of the largest privately held companies in the world. Now, remember, guys, that $300 billion valuation, that $40 billion raise from SoftBank, that was contingent upon OpenAI making the transition to a for-profit company. Remember, OpenAI is a charity. Gotta love it. My, what big not profits you have over there, Sam Altman. Your company doesn't make any money, but you seem to be getting filthy rich off of your charity work. I wasn't aware that's how charity works, but I digress. Look, in recent months, OpenAI lost several members of its research staff to Meta Platforms as the latter firm aggressively recruited top talent from Apple and other competitors for its superintelligence AI team, offering pay packages in the 9-figure range. A secondary sale for OpenAI could serve as a way to incentivize staff to remain at the company who are being offered lavish compensation. Guys, this is a desperation move from OpenAI. And look, they're obviously going to be successful here. It looks like people will open up their wallets to buy a piece of OpenAI. But the reason they're doing it is because if they don't, they're going to keep losing people to Meta. And look, Meta has a history of just not giving a shit how much of their investor capital they waste. See, also, they're still burning billions of dollars every quarter on the metaverse. And OpenAI doesn't make any money, so they don't have the cash to pay competitively. They need to do this raise just to stop the bleeding of people, which means their bleeding of cash is going to get even worse. But for now, investors are willing to pay up for it. All right, let's talk a little bit about Disney. A lot of Disney news this morning. First of all, Disney earnings top expectations as streaming and parks offsets TV headwinds. So there's some good news and some bad news in here. Disney reported results for its fiscal third quarter on Wednesday, posting earnings that topped expectation, but revenue that came in just shy of analyst projections. As the company's streaming business grew and its theme parks saw higher spending from customers, net income for the quarter was $5.26 billion or $2.92 a share. That's more than double the $2.62 billion or $1.43 per share that the company reported last year. Although adjusting for one-time items primarily related to the tax benefits associated with Disney's purchase of Comcast Hulu stake, Disney reported earnings per share of $1.61. That's much more modest growth, but it is still growing. Disney's overall revenue rose 2%, $23.65 billion, missing analyst expectations for the first time since May of 2024. Now, guys, it looks like the company reported growth in its streaming business despite headwinds in that traditional TV bundle. It's that traditional TV bundle that's really hurting Disney here this morning. People are overlooking the good numbers from their parks and experiences. Disney's cruises and theme parks are doing great. Now, in order to reverse that decline in their TV business, Disney is spending money. They're buying some other assets here. Disney's ESPN to acquire NFL media assets in a major deal. This one was just announced along with the earnings. Walt Disney's ESPN has reached a landmark deal with the National Football League to acquire the NFL network and other media assets from the league in exchange for the NFL taking a 10% equity stake in the sports network, the party said on Tuesday. The deal, which ESPN said would bolster its offerings on its upcoming ESPN streaming service, is subject to regulatory approval, and no value was provided. Analysts and industry insiders estimated the NFL stake in ESPN could be worth $2 billion to $3 billion, though the companies declined to comment. Look, football streaming rights are incredibly lucrative. No matter what happens in the league, people always put their entire lives on hold on Sunday to watch football. And so Disney's trying to get a piece of that to try to reverse the bleeding over at ESPN. But it's not just football that they're buying. Disney is also paying $1.6 billion for WWE rights. ESPN unit will stream WrestleMania and other major offerings for 5 years. Disney's ESPN and TKO Group's World Wrestling Entertainment have reached a more than $1.6 billion agreement that will give the sports media company exclusive rights to many of WWE's most high-profile events. The 5-year deal, which will begin in 2026, includes the U.S. streaming rights to major events, including WrestleMania and SummerSlam. ESPN will pay $325 million a year for the rights, according to people familiar with the matter. That is a significant increase from the WWE's current 5-year deal with Peacock, which was valued at $900 million, according to people familiar with the pact. The people familiar with the pact, are they related to people familiar with the matter? I don't know. The names sound alike, but maybe no relation. Look, Disney stock not doing so hot this morning, down 1.3%. It's those losses in the TV business that seem to be driving investor sentiment right now. Although, to be honest with you, that football deal is probably pretty encouraging. I think that could end up making them some money in the long run. All right, let's check in on the meme stocks. How are they doing this morning? Open Door tanks after earnings as CEO thanks new investors for increased visibility. So long and thanks for all the fish, Open Door CEO says. Yikes. Open Door shares up almost five-fold since the beginning of July, and trading volumes hitting record levels. CEO Carrie Wheeler thanked investors for their enthusiasm on Tuesday's earnings call, right before all their money went up in smoke. I want to acknowledge the great deal of interest in Open Door lately, and that we're grateful for it, Wheeler said, even as the stock sank more than 20% after hours. We appreciate your enthusiasm for what we're building, and we're listening intently to your feedback. All right, so what are they building? Let's see. Much of the stock's bounce in the past 6 weeks was spurred by hedge fund manager Eric Jackson, who announced in July that his firm had taken a position in Opendoor. Jackson said he believes Opendoor stock could eventually get to $82. That is just slightly above Tuesday's close of $2.52, before dropping even further lower to $2 in extended trading. Jackson's bet is that a return to revenue growth and increased market share will lead to profitability, and that investors will start ascribing a reasonable sales multiple to their business. Guys, this is an online platform that buys and flips houses. What is a reasonable sales multiple for that business in this environment? The turnaround isn't yet showing much evidence of working. For the second quarter, Opendoor reported a revenue increase of about 4% to $1.57 billion. Its net loss narrowed to $29 million or 4 cents a share from $92 million or 13 cents a share a year earlier. In the current quarter, Opendoor is projecting just $800 to $875 million in revenue, which would represent a decline of at least 36% from a year earlier. Opendoor said it expects to acquire just 1,200 homes in the third quarter, down from 1,757 in the second quarter and 3,504 in the third quarter of 2024. It's also pulling down marketing spending. The housing market has further deteriorated over the course of the last quarter, finance chief Salim Friha said at Tuesday's earnings call. Persistently high mortgage rates continue to suppress buyer demand, leading to lower clearance and record new listings. In other words, the housing market sucks right now, and there's just no possible way Opendoor is going to $82 when they buy and sell houses. People don't want to buy houses right now. Look, this stock is still up big, but it's down 21% ahead of the opening bell, trading at $1.99 after rising from a value of about 55 cents to over $2.07. What did we get? We got to a high of almost $5 intraday. What was that on July 21st? Now back below $2. Look, guys, just be careful with the meme stocks, all right? If you're going to engineer a short squeeze, you can make a ton of money in a hurry as those shorts get squeezed. But once that squeeze runs its course, you are left holding a company that does not make money. Don't forget to take profits because you can see how fast they go up in smoke. Meanwhile, we got results from Uber. They boost their buyback by $20 billion after an upbeat forecast. It seems Uber's business is doing pretty well here. Uber Technologies announced a $20 billion in new stock buybacks after sharing a better-than-expected third-quarter forecast and quarterly results, suggesting that growth at its core rideshare and delivery units still has room to pick up steam. Gross bookings, which includes ride hails, delivery orders, and driver and merchant earnings, but not tips, will range from $48.25 billion to $49.75 billion for the 3 months ended in September. Uber said in a statement Wednesday, Wall Street was projecting $47.6 billion. So the guidance was pretty strong here. That would represent an 18 to 21% growth rate. According to Bloomberg calculations, that's faster than the 17% gain in second quarter bookings. So not only solid growth at Uber, but that growth appears to be accelerating. Uber stock is getting rewarded for that this morning, up 1.4%, $90.75 for Uber shares. That $20 billion in buybacks is certainly going to help things there. Meanwhile, McDonald's returns to sales growth with toys and budget meals. You know, we just got done talking yesterday about Yum Brands that was looking just not very good. That's Taco Bell and Pizza Hut, and there was another one. I can't remember the name. But they were trying to mimic McDonald's results. They're all announcing that they're going to have big discount items coming and big promotions for those discounts in the future because McDonald's has been very successful with those discounts. It's almost like the solution to higher prices is higher prices. McDonald's sales picked up in the latest quarter, suggesting that pop culture-focused collaborations and budget meals are helping to offset diners' economic anxiety. Global sales at restaurants open at least 13 months rose 3.8% in the second quarter, the company said Wednesday. That's higher than the average estimate of analysts polled by Bloomberg. International markets led the company's growth, while the U.S. was slightly ahead of expectations because of larger check sizes. The results ended 4 quarters of declining or tepid growth as the burger chain dealt with an E. coli outbreak, backlash against American brands in the Middle East, and consumer unease about the economy in response to President Trump's trade disputes. And this is Bloomberg. They just can't help but be their New York liberal selves. you ever say to yourself, man, I'd love to go to McDonald's for lunch, but those tariffs. I couldn't get McDonald's lunch because of the trade war. Freaking nobody ever. Look, the reason people are not eating at McDonald's, or the reason people were not eating at McDonald's, was because of inflation, because of the cost of living. They couldn't afford it. They were cutting back on eating out. So McDonald's announced that they were coming out with these budget meals, this $5 meal, lower prices, and affordable lunch. It was wildly successful, and it brought people back in. None of those things has anything to do with freaking tariffs. Bloomberg just has this narrative that must be included in every article. It's like a memo at Bloomberg headquarters went out and says, no matter what you guys are talking about, make sure you mention unease about the trade war and make sure you phrase it in first person possessive. President Trump's trade disputes, President Trump's tariffs, President Trump's trade war. No matter what, that has to be included in every article, even if you're talking about a freaking $5 value meal at McDonald's. But I digress. McDonald's stock looking all right this morning, up 3.6%, $309.60 for McDonald's stock. That is up a decent amount this morning. All right, last one we're going to talk about is the ISM Services PMI. All right, ISM, that's Institute of Supply Management and Services, obviously not goods. We're talking about services. And then the PMI, the Purchasing Managers Index. All right, these are interviews that they do with purchasing managers from various companies, and then they create this index. It's keyed to 50. Any number higher than 50 is growth. Any number below 50 is contraction. All right, there's no units here. It's just a growth contraction kind of number. And the ISM Services PMI yesterday was, stagnant. The ISM Services PMI unexpectedly fell to 50.1. All right, so 50.1 is down from 50.8. It's lower than it was, so it fell, but it is still just barely in expansion territory. So services are expanding at a much slower rate. That's below forecast of a 51.5 reading. The reading showed the services sector nearly stagnated, with seasonal and weather factors having a negative impact on business. A slowdown was seen for business activity, production, new orders, and inventories. Also, price pressures intensified in the highest since October of 2022. Yikes, keep an eye on that. With the most common topic among survey panelists remaining tariff-related impacts. All right, so in this case, yes, this is due to tariffs, all right? And this isn't Bloomberg's McDonald's story. This actually is tariffs adding to pricing pressures, particularly in commodities. There's your steel and aluminum tariffs showing there. We saw that with Caterpillar's earnings earlier this week as well. In addition, employment fell faster and remained in contraction territory for the second month in a row, and the fourth time in the last 5 months. Backlogs of orders continued to decline, and supplier deliveries slowed. Meanwhile, new exports and imports both moved from expansion into contraction territory, providing signals that tariff tensions are impacting global trade. Now, we have seen the imports are falling a lot faster than the exports are falling, which means that trade deficit is getting smaller. And that actually results in economic growth in the GDP numbers. Not going to hear that mentioned, though. Look, here we are, 50.1 for July, down from 50.8. We've kind of been right around this 49 to 51 level ever since the trade war started for ISM Services PMI. But here's what people are really worried about in this number. All right. First of all, the employment that's included in the ISM, big time contraction, 46.4, well below that 50 threshold that would signal growth. All right, that is the second month in a row. That is the fourth out of the last 5. You can see here, starting around February, services employment started to contract, the one exception being May, where it was slightly in expansion territory. All right, so we've got employment contracting. Now look at prices paid. A huge surge in prices paid, 69.9. That's up from an already very high 67.5. And again, this all started right around the time of the trade war. We were already in the 60s, and that's going all the way back to last year. I mean, ISM Services, this has been in inflation territory for years here, but it is accelerating to the upside. So you've got slowing employment, declining employment. There is your stag. And then you've got prices rising quickly. There is your inflation, stagflation, all right? That Keynesian phenomenon that should not exist according to the Keynesian economic models. You shouldn't be able to have low employment and high inflation at the same time. And yet there it is again, baffling the Phillips curve. How is this possible? Probably because Keynesian economics is just wrong about pretty much everything. Staggering inflation is showing in that ISM services PMI, guys. Keep an eye on that one. That is a concerning statistic. And by the way, this is Institute for Supply Management. This is not a government statistic. This is private sector data. And I just want to say thank you very much to Mr. Zeeble Fritz. Thank you, Z, so much for supporting the channel, sir. He says 1080p stream looks great. When 4K? We're not going to have 4K anytime soon, but StreamYard just doesn't support 4K. I replaced some of my equipment after the internet hiccup that we had a couple of days ago, where I had to cancel midstream because the picture wasn't coming through. Had to do a pre-record, shotgun that out real fast. I said, all right, enough with this. Replaced my modem, upgraded the stream quality a little bit while I was doing that. So far, so good. But 4K, don't hold your breath on that one. The platform just doesn't support it. But I thank you very much for being a Melonhead member for 14 months. Thank you, Zeeble Fritz, so much for supporting the channel, sir. And thank you, everybody, for having your coffee with the Melonheads this morning. Shout out to my Patreon supporters on Patreon and YouTube. Thank you so much, my magnanimous Melonheads. Links down below, should you feel so inclined. Look for that video later today about the thing that isn't happening again. It's funny how that always works out that way. Don't forget the like button and the subscribe button on the way out. Hi, Mom. Hi, Dad. Love you guys. Everybody, till next time, live small and dream big.